Welcome to Peter Lynch's Greatest Lessons, where I'm highlighting my favorite parts of all the books that he's written. This lesson will be on famous numbers. As always, liking, subscribing, and hitting the bell if you haven't done so already is greatly appreciated. And if you're interested, consider joining with the Market Moves Investing Book Summaries link in the description down below. What he's saying in this is, what do these numbers really show? What does percent of sales mean to you? Is a high or low PE considered good? How important is the growth rate? And where do dividends come into all of this? Let's watch a short segment on my longer series to explain this lesson. Now let's get into some famous numbers. The percent of sales. This is the really important number to look at when you find something with your edge. How much impact does that product or service have on the company you're looking at? Let's say you know that some new plastic is going to explode in popularity. It's lighter, more durable, biodegradable, and, the best part, it's cheaper than the other methods, which means it's actually going to get used. Why is percent of sales important here? Well, who gets excited about plastic? Let's say two companies sell that amazing new plastic. Mega Company A, where percent of sales for this plastic is 2%. Heavily diversified, and plastics only makes up about 10% of the business. Versus Medium Company B, where percent of sales for this is 30%, and almost all revenue comes from plastics. Using your edge plus market research, you believe that the sales of this plastic will double within 2 years. Which of these companies would you want your money to be with? Clearly, the Medium Company B would be better in this case. A larger percent of their earnings comes from what you believe will be a big winner. Percent of sales helps you determine, 1, if your winning product will make any impact in the company, and 2, how much risk you're placing on being right. Your edge, which gives you confidence that you will be right, helps determine risk so that you can end up the big winner. Next is probably the most famous, which is the PE ratio, and this one is talked about constantly. It's how much you're actually paying for the company and the earnings that it has. And since stock prices are changing every day, that means that the PE ratio is also changing every day. What's the rough rule of thumb that Peter uses? The PE ratio of any company that's fairly priced will equal its growth rate. What's he saying here? If the PE is 20, then a fair price would be to assume 20% growth rates in the earnings. What about dividends, some people might say, and we'll get to that later. What earnings numbers does he look at? Number 1 is the average earnings growth rate for 10 years. Number 2 is the average earnings growth rate for the last 3 years, and that's just for the rough estimations. Also, ideally, the last 3% would be better. The purpose of any company is to grow that money into the future. Thus, you'll be looking for the future growth rates. Past growth is technically worthless. However, it's nice for a rough estimate. Future growth rates, you might say. How do I get that number? And Peter says, your guess is as good as mine. That's what makes investing so hard. Well, what about companies with dividends? And no, we aren't ignoring dividends. Peter has a slightly more complicated way to look here. Growth estimate plus the dividend yield divided by the PE ratio equals some number. So for example, 15% growth plus 3% yield divided by 12 PE gives us 1.5. Well, what's this number useful for? It's for more rough estimations. Clearly, you're still going to have to find the qualitative advantages of companies and also factor in the debt obligations and other factors such as that. However, this is a nice starting point to possibly find great choices. So the numbers guide goes like this. Less than 1 equals a potentially poor choice. Equals 1.5 is a potentially fair choice. And anything above 2 is a potentially great choice. So go out there and find some big numbers for me. Then there's the cash position. He loves the bonus cash, money after debt. Like some delightful hidden rebate, is what he says. Peter considers the cash position like this. The stock is sitting at $50 per share. Each share holds $15 in cash. Thus, the price was $35 per share. He also considers this when taking PE into account. For example, we have our example that we talked about previously, the $50 stock price with the bonus cash of 15 going back to $35 per share. Now, assuming the EPS on this stock is 5, that would mean that the market PE would be the 50 divided by 5, which gives us 10. However, the rebate PE is 35 divided by 5, which gives us 7. Try doing calculations with both. Then there's the dividends. And the famous Rockefeller quote, "Do you know the only thing that gives me pleasure is to see my dividends coming in?" There's certainly a lot to like with dividends. He wants to see if the company paying a dividend is helping or hurting them. Here you go. Thanks. Big issues he's seen is bad management plus no dividend. We mentioned previously about getting a rebate. Why not always stack cash then? Good management can really make the difference in this. Bad management can get creative with losing money. Number one is diversifications, which is, in his eyes, buying bad acquisitions with low synergy in the company, usually at bad prices as well. Number two, increased risk taking, thinking there's a safety net so they don't do things rationally. And three, stock options for management for their good work. And he feels that having a dividend makes them more cautious and less likely to make poor choices in this manner. Dividends are also nice to help reduce dramatic drops. When the price drops, that means yields go up, and having bigger yields makes the investment more attractive to purchase at the time. Being more attractive means more buyers, and that can help prevent dramatic price drops in the future. However, the company cutting or removing dividends will often cause the drop to be significant. Dividends are a choice, they are not mandatory. So if they are so great, why doesn't every company do it? Sometimes companies should retain the money. Are they in a competitive space where cash on hand is useful? Is this a small company with great internal returns? Does the company have a lot of debts and need to retain cash? Should I stay or should I go? Then there's book value. The flaw is that the stated book value often bears little relationship to the actual worth of the company. It often understates or overstates by a large margin. Supreme! I have 50 shirts. Each one is worth $300. Overvalued assets can be presented on the balance sheet. Raw materials are easy to determine asset values for, such as cotton. Branded shirts are much trickier to price in. What's the value of putting it all together? I'll sell you some cotton for $300 per pound. No thanks. Inventory that keeps piling up can be listed as assets, even if nobody has been buying it for years. You should determine the book value yourself, not take it for granted. That's how you can find asset plays too. Am I assets or junk? Then of course there's the growth rate. This one's critically important. It's the essence of finding the 10-bagger. Growing big and strong is super important for smaller companies. That's the only growth rate that counts, earnings. Does your company get progressively better earnings numbers? How much better? What's the percentage? And how does that percentage compare to the PE? And he's talking about earnings growth rate, not expansion. Just because the company has 10 new stores doesn't mean that the earnings are increasing. So would you be looking at low growth rates with low PEs or high growth rates with high PEs? Let's take a look at this chart where we have company A, which has a 20% growth rate each year, versus company B, which has a 10% growth rate each year. At the start, they each start with $1 per share. But over 10 years, company A gets to $6.19 per share versus company B, which has $2.59 per share. Okay, so obviously more growth gives better earnings over time. What does that do to my investment? Well, let's see the numerical difference in our investments. Let's say the 20% growth got a fair PE of 20, and let's say the 10% growth got a fair PE of 10. Assuming the 20 and 10% growth happened yearly, and the PE being paid is still fair relative to the percent growth in the last year, this is the difference in our investment between the two. Company A, which was the 20% grower, is 20 for the PE times the 6.19, which gives us $123.80 per share, versus Company B, which was a 10% grower with a 10 PE. You get the 10 PE times the 2.59, and that gives us $25.90 per share.